Hey everybody, Benjamin Ficker here, your local multifamily investment broker. Very excited for our webinar today. We're going to be joined by our good friend Dan Hayes, owner of Real Property Management Solutions. Michael Coffey is a local commercial lender. Michael Popno, residential lender with Neo Home Loans, and Martine Tamick, my preferred residential real estate broker over at Keller Williams Realty. If you don't know who I am, my name is Benjamin Ficker. I'm an active apartment broker. Been doing real estate for since 2004. Most recently, I was with Equity Pacific Real Estate since 2015. But the big announcement, I moved brokerages over to Keller Williams Realty Sunset Corridor. No hard feelings with Equity Pacific. It's by far the best time of my life in real estate. I learned so much from Jason, the principal broker over there. But really, he's building a business in Idaho and Washington, and not in Oregon as well. He's still doing plenty of business in Oregon, just not as much. And really, I was just in the office by myself a little bit too much, and was just ready for a change of scenery. So him and I are still planning on doing deals together. He's the guy that I call to with questions, and he asks me questions about the smaller Plex stuff, and I look forward to years of working together with Jason. So here's the quick agenda for today. We're going to talk a little bit about the multifamily market. I'm going to have Michael Coffey do a piece on the commercial financing. Dan Hayes is going to jump in with some rent trends and talk about the landlord updates. Mike Popno is going to give us a breakdown on the residential financing updates. And then Martine Tamick is going to let us know what's going on in the single family and small plex residential resale market. And then we'll end with some final thoughts and action items. And go from there. Oh, and also, if you're not aware, this is a re-record of the actual live webinar we did. So the Q&A is off the table because we already did it, but we had some technical glitches. So enjoy this wonderful replay. So, all right, let's jump into it. Multifamily market update. So we use data from CoStar and from RMLS to try to cover all of our bases on the multifamily investment transactions that happen. So CoStar, Q4 of last year, they had 68 total transactions with an average cap rate of 5%. Price per unit was 297,000, ranges from 65 to 458. So a couple of really big deals really skews those numbers one direction. The current properties listed for sale in CoStar is 119 properties. Only 8 of those are under contract. So that is, let's see, if we do 8 divided by 119, that's 6.7% of the inventory is actually under market. And if you did 119 divided by 8, that's 14.875 months of inventory. Now, commercial always has a longer inventory. Deals just take longer to close, but this is drastically different over what we've seen over the last few years. And part of that is, I think, is that we haven't seen the buyer and seller expectations meet yet. Sellers recognize things are changing. Buyers think things have drastically changed. They haven't that much. But we're just not, people aren't quite aligned just yet. But based on my conversations I've been having, I do anticipate that to change later this year. So let's see, the properties under contract. So let's go back and look at what sold. Average price per unit, 297 sold. Average cap sold. This is off of the data that that the brokers provided to CoStar. And if we look at what's currently under contract, you can see that cap rate jumps up to 5.47% on the advertised numbers on CoStar, and that price per unit drops down to 240, right? So this is what I was saying, where there's a lot of those active properties just aren't the active price per units 253. That's a little bit higher, but you can see that expectations for parties just aren't quite aligned just yet. So let's jump into the RMLS. This is specifically 2 to 4 units. In Q4, there was 88 properties sold. Price per square foot was 246, and the price per unit was 279. The one thing I want to note, with anything that we pull out of the RMLS, I don't really like to use their cap rates or their GRMs because a lot of brokers don't do that data accurately, and it's a lot of work to go back and clean that up. It's actually a project we're working on, is going back and cleaning up all of those old sold comps and finding out what those real GRMs and cap rates were, so we can see those trends. But it's just tough to get accurate data out of RMLS when people don't know how to put it in the right way. So we like price per square foot. That's hard to mess up. Price per unit's definitely hard to mess up. 279 price per unit, and this is 2 to 4 units. The properties, so those are the ones that sold. The property, so an important part about the solds, that we get this info from RMLS, we don't get it out of CoStar. There's the original asking price when the property went on the market. That average price per unit was 302. At the time the property went under contract, that price had dropped to an average of 290, and then the actual sold price dropped to 279. So if we do 279 divided by 302, we're at roughly 7.5% difference between where they started and where things are ending up. So just something to keep in mind when you're looking at valuing the properties. So for the things that are currently for sale, the Portland metro area, meaning Clark County, Clackamas County, Multnomah County, and Washington County, we've got 128 2 to 4 unit properties for sale, including 31 properties sold or under contract, excuse me. So that is 24.2%. About a quarter of them are under contract. Where on the CoStar numbers, it was 6% of them, 6.7% were under contract. And now if we do the numbers of 128 divided by 31, that's 4 months of inventory versus the 14.7 months of inventory for CoStar. So things definitely move a little more briskly in the 2 to 4 unit space, and that's just mostly because people aren't used to buying. It takes a lot more to purchase a 5+ unit than it does a duplex. And price per units here are sitting at right around 296 of the currently the properties actually for sale. For under contract, we are looking at an average of 299. That's similar to the for sale ones. So actually bumped up a little bit. Now a lot of that might be actually that would come up with for sale. So 2 to 4 units. This might be because of the larger property selling, like the fourplexes selling, or excuse me, the duplexes selling, because those tend to sell at a higher price per unit than fourplexes. But boots on the ground information, everybody that I'm currently working with, the focus right now is, does the deal actually make sense today? Not, does the deal make sense in 2 years, right? If you and I talked about selling your property 2 years ago, we could count on the buyer making their decision on where they could bring this deal in a couple of years. Where the conversations right now are, does this cash flow today? How am I making a good investment today? Am I losing money today? And we are past the period of selling based off of pro forma numbers. People still want to see that upside, but they're not going to do it and lose $6,000 a year in cash flow. So that's it for the multifamily market update. I'm going to come back here in a couple of minutes with Dan Hayes giving us the rental information, and then the two mics and Martine, and we'll end with some final thoughts and some action items. So thank you so much. Dan, over to you. Dan, thank you so much for joining us again. Obviously, we had a little bit of a technical difficulties, but I really do appreciate you jumping back on and helping our mutual clients be better owners of investment properties. So for those who don't know Dan, why don't you tell us about yourself, and we'll jump into it.
Yeah, thanks, Ben. I have to say, you really handled that technical difficulty like a champ. I will tell you, I'm not so sure I would have had the patience that you did. So great job. My name is Dan Hayes. As Ben said, I'm one of the owners of a family that owns Real Property Management Solutions, a local residential management firm here in town. We operate in the 3-county area. We do on the residential side of things, everything from an ADU up to mid-market multifamily, and we're now taking on major multifamily as well. So if you've got a need, we probably can fill that need.
Great, perfect. And we've chatted a little bit about what's going on in the multifamily market, and we've heard from some lenders. what's happening on the rental side of this business? Where are rents? What are the trends you're looking at? Yeah, what do we need to know?
Yeah. So you want me to present those slides? Or you just want to give you a quick verbal description of what we've done?
Let's do the slides. Let's do them. If you got them,
Okay.
let's do them.
Yeah, I think it's helpful. I mean, by using the slides, I can give you a visual representation of what's happening because there are some real mixed signals in the rental market right now. The headline is this:
Oh,
we
sorry,
had
real,
a
real quick. Are you showing us the slides? Because I'm not seeing
yeah.
them.
I'm going to share them to you now. Let me
Oh,
share. Let me
perfect.
share them with
Yeah,
you now. That'll be helpful. So let me share my screen. Let me get there. And Ben, can you see that?
there we go.
Okay. So what's happening in the rental market is interesting in that starting with a look nationally, what's taken place over the last couple of years is pre-pandemic rents have been following the normal trend. One of the things that attracted me to this business in the first place was a pretty predictable revenue stream. We all know rents typically go up a point or two in the spring and summer, they come down in the winter, and we repeat that process. And then what happened is that, of course, we all locked down for this pandemic and we had a collapse in households. And right when rents were supposed to be going up, they actually went down nationally and locally. Started to come back a little bit as parts of the country opened up in the latter part of 2020. In this market, we finished 2020 down 7% as we ended 2020. And then in the beginning of 2021, the Katie bar the door, opened the gates because it started to really go get catch on fire. And what was happening is that we had an explosion of households. In fact, the United States reached a new peak in the number of households in the summer of 2021. Over 131 million households were formed.
Hmm.
And those households formed almost faster than the collapse of households in the beginning months of the pandemic. And we just frankly didn't have the supply to meet that demand. And that's what you see here in that 2021 graph. We had a substantial rent increase for almost the entire year. In fact, in the United States, depending on which research you want to believe, the big database I use showed that rents finished in the United States up just under 18%. Portland finished up 7%. And we usually are significantly lower than the national average, but we had the same dynamic happen here in Portland Metro. Some markets experienced upwards of 25 to 30% increase, like Beaverton and Hillsborough. And then we had a slight downtick in December, and then 2022, we had another robust rent increase year on top of a really big base. So that's where we are as we head into the winter. And then we started to see the normal seasonal slowdown in that August and September timeframe. Thought we were going to see pretty normal rent declines in the fall and winter, but what's happened, frankly, in the United States and locally, which I'll show you in a moment, pretty substantial rent declines from a month-to-month standpoint, twice what we normally see
Hmm.
on a seasonal basis. So what happened locally is this. For 2022, we were looking at a mid to high single digit rent increase in Oregon and Portland. In fact, Portland and the state of Oregon was tracking pretty close to the national average. And then we had a pretty big cliff in November, December, especially in Portland. Portland finished up just about 1.7%. Oregon finished up just under 4%. Nationally, we finished up 4%. So pretty big decline as we headed into the winter. Now, we'll see what December to January holds, but here's my take on things, Ben. We are now starting to see the impact on household budgets in a big way. The
Hmm.
inflation is truly having a big impact, and I'll talk about that in a second. But if you are looking at your rental portfolio, and Ben says this all the time, you got to get your rents to market so that when you sell your rental property, that asset has the value that your buyer wants to see. We have an open window of time right now where we've got the kind of rent increase leverage through Oregon's rent control law at 14.6%, and rents have really slowed down. So you could catch up pretty quickly. This would be your year if you're well below market. Now, if you're at market or maybe even slightly below market, I can tell you it's probably in your best interest to take a measured approach. For Hayes Enterprises properties, I'm at or above market for all of my rental units. It's just the way I operate. but I'm going to take a very conservative approach at lease renewal because I think it will be harder to fill a unit in 2023 than it did in 2022. And I would rather have that unit filled than have a vacancy. But I'm also going to make sure that I'm following those trends closely because I don't want to lose value as a result of not taking the kind of rent increases that the market will bear. So it's going to be a tricky balance this year for sure. It's not as straightforward as it once was.
Yeah.
When you take a look at outside of Portland Metro, from a month to month standpoint, those markets that had some of the highest increases since March, like Hillsborough, like Beaverton, like Lake Oswego, you're seeing a month to month decline that's pretty robust. Beaverton down almost 2, Hillsborough down 2. Portland, again, was a pretty big cliff in December. But what we're seeing is a pretty rapid decline, relatively speaking, from a month to month standpoint. But those same markets had a pretty good year. Beaverton up 7, Tigard up 6, Wilsonville up 5.5. So again, don't believe everything you read. Look at your property, measure it against the market, get to a rental analysis that's city specific, if not neighborhood and zip code specific, and you're going to have a good result. What's driving a lot of this big rent increase outside of the city of Portland is, of course, supply. What you're seeing here is straight out of Multifamily Northwest's fall apartment report. As you know, Multifamily Northwest is the largest association. We're members of Multifamily Northwest, 270,000 units under its association. And this is the self-reported report that comes out in the spring and the fall. This is the fall. It happened just a couple of months ago. And what you see is that red line at the national average, around 5.7% national average vacancy rate. And you can see every single neighborhood or city, depending on what you're looking at, is below the national average with the exception of downtown Portland. The interesting thing about downtown Portland and the Pearl is those vacancy rates are about 2 points better than they were a year and a half ago. So as much work that needs to be done there, and there's a lot of work to be done downtown Portland, of course, those vacancy rates are getting better. Some cities are below 2 points vacancy. So when you're looking at where your properties are located, perhaps where you may want to think about selling, and you've got low vacancy rates, getting your rents up is really going to serve you well. Okay. Also pretty good information if you're thinking about selling as an owner-occupied approach. As Ben has been talking to us for some time, duplexes probably aren't going to pencil in year one, especially with higher interest rates. What likely is going to happen is you're going to sell it to somebody who's going to live in a unit. So looking at those markets that have really low vacancy rates might be a good opportunity for you to look at that strategy. Of course, talk to Ben about that. So let's talk about some rental trends in 2022 and what they may have in terms of an implication to 2023. Let's rewind it a bit. Rent growth has come back to earth, okay? Like I said, a big number times a big number is a big number. And we had a really big increase in 2021. We had a pretty good increase going into 2022, really starting to moderate. So rent growth is coming back down to earth. So the headline here is take a look at where you're at versus the marketplace. Get to market, but be conservative as you look forward because it is starting to slow down. Number of households is also starting to cool. What that means is we're not getting a lot of churn, which means we don't have as many units opening up like we normally do. This industry needs a healthy amount of churn. And when households form, we get churn. Well, people are now staying in place. Number one, interest rates are really high. First-time home buyers are now not buying homes. So they're staying in the rental units. People who don't have plans to buy a home are not moving because inflation is so high, they can't afford to go get that apartment that's had such a high rent increase in the last 12 months. So household formation is starting to cool things down. And vacancy rates are going up. So more options for renters is going to be here for the next little bit. Moreover, we're starting to see a shift from what was hot to what is now hot. So in the Sun Belt, that purple line was 2021. The blue line is 2022. The Sun Belt has really slowed down. Yeah. The Midwest has taken its place. So if you are looking to invest outside of Portland, maybe sell your property here and move your chips elsewhere, you may want to think about the Midwest where things are really quite robust. I've got a friend who's investing in Kansas City and he's doing pretty good. Rents fell off a cliff in December in Portland, but that doesn't mean that the rent increase that you've experienced in the marketplace over the last 18 months doesn't have some upside for you. Okay. Again, just be conservative in the outlook, but make sure you're right currently. And the suburban boom continues. We will expect to see more growth for rent prices in the suburbs than the inner core. So as you think about where you're at, think about what's happening there, how people are continuing to move out of urban cores and out into the suburbs. That is continuing. Now, multifamily construction is high. So that means that there are plenty of apartments that are being built across the United States. Okay. Here locally, we've delivered a lot of inventory in the studio, single family, and even studio, single bedroom and 2 bedroom units. At the same time, the Portland metro market has lost approximately 6,000 single family rentals in the last few years. Those 6,000 single family rentals have not been replaced by multifamily construction. So as you think about your asset and where supply and demand sits, also would inform your strategy. Remote work will face its biggest test. And here's what I mean by that. When you look at renter preference survey data, the number of renters who intend to work from home permanently or most of the time is over double what it was pre-pandemic. That's the master of the obvious. Here's the problem. The problem is that employers may not tolerate that level of work from home. So we're going to find out in 2023 how that's going to shake out between workers who want to work remotely and employers who probably are not going to tolerate that. No matter which way it shakes out, highly recommend you think about accommodating that change in the marketplace. If you've got a unit where you can provide some work from home space that's not the kitchen of the corner of the kitchen table or the corner of the bedroom, you just put yourself at the top of the list of desirable units. And then household budgets have hit this ceiling. In my opinion, that's also what's cooling down rents. Here's what I mean by that. And if you think about the way inflation moved, it makes a ton of sense. First thing that hit family budgets was a pretty good increase in 2021 in rents, as we've talked about. What trailed rent increases? Well, gas prices came after that, then high food prices after that. So now what we're seeing is a total household budget under an extreme amount of pressure, which is really causing folks to not even be able to afford at all some of the rents that we're seeing out there. And it's just causing that price ceiling where people are starting to come down a little bit to get properties rented. So again, inflation being as high as it is, be careful in 2023. Just make sure you know your numbers. All right, we talked about that renter preference survey. There are some real numbers here. Number one, demand for more space. This survey showed that 28% of the renters who were surveyed said they intend to move to a different community when their lease expires because they need additional living space. That's up 19%. Being able to get away without having washers and dryers, that's over. Air conditioning, never been more important. And because people work from home, soundproof walls and high-speed internet. In fact, the percentage of renters who are interested in these amenities is above 90% across the board. Okay. And they're willing to pay more. I can tell you, I have personal experience in this market as to what you can get for an in-unit washer and dryer, as well as adding air conditioning to a unit. You'd be shocked at the payback. And then finally, because we're working from home, because we live at home more than ever, package delivery increases is through the roof. So how can you accommodate security, whether that's environmentally friendly design that blocks the view from the sidewalk to the front door, whatever it may be? Think about that change in attitudes and perceptions as to what renters want because of the way they live their life now. Okay. And then finally, as an update, this 14% rent increase cap has a lot of folks super nervous. Now, Ben and I were talking the other day. Man, would I love to get 14.6% for my portfolio? That's not going to happen because that's not how it works. We all know that, but that's not what the press believes. And we're now seeing tenant community or tenant advocacy groups like the Community Alliance of Tenants really advocating talking to legislatures around saying no to that 14.6%, in addition to more stuff around tenant protections. Multifamily Northwest, we're all being encouraged to talk to our legislatures. Did you know in the last couple of years, housing providers have had to tolerate 72 different proposals that were passed that had to do with housing? 72. So a lot of that pressure's on our backs to solve the problem. We're trying to make sure everybody in Salem understands that's not the way to get there, as we all know. So you can expect more legislation. Please keep your ear to the ground and let's fight the good fight. And that's really all I had, Ben.
Real quick,
Um,
on that note, we the last few years we had a lot of legislation talk, right? There was how many different versions of the COVID relief stuff going on, right? Right now, there's the stuff around rent control that you just discussed, and then I'm seeing in May they're coming up for a vote on adding a 3/4 point capital gains tax in Multnomah County. Is there other legislation stuff coming down the road that you're aware of? Any other things that we need to keep our eye out for?
yeah, here's what so this has not hit my inbox yet, but here's what I think. More taxes or fees to support eviction protection.
Yeah,
That's a bit of a move across the country. And what's driving a lot of that, of course, is the fact that we had an eviction moratorium.
yeah,
We all had tenants, myself included, who didn't pay during that moratorium. And of course, they're in a position now where they can't pay. So evictions, of course, are up. And it's got people pretty freaked out. So I think we can absolutely expect to see something in addition to that proposal that's going to hit the ballot in May around landlords paying for tenant attorney support, etc. That's number one. Number two, I have no doubt in my mind that the 7+ inflation rent control limit is going to be discussed.
yeah. And
And that was
actually,
all that.
you and I talked about this when it came out, right? We're like,
Yeah,
this is a
that's fair.
foothold, and then they're gonna bring it back down when they can, right? This
Yeah.
is the foothold to
It's
get it.
already passed, right? Yeah.
Yeah,
And we remain the only state in the United States that has statewide rent control.
yeah,
Other cities in Florida, California, St. Paul, Minnesota, 3%, by the way, they've passed rent control, but a lot of folks are modeling rent control after Oregon's statewide model. So you can expect it to go nowhere but down,
yeah,
if you ask me. The third thing I think we're going to see is a continuation of a restriction on anything that you can charge the tenant. I wouldn't be surprised if pet rent hits the discussion again.
mm,
You remember that hit
hmm,
the docket as an agenda item pre-pandemic, and then it was killed, but and never has not resurfaced since. I think that may come back, but I think you can expect to see some of that happening. But the bottom line is, I think they're going to throw as much at the wall as they can to see what sticks just because that's the way it's been going. And I just, the good news I think is that we don't have a super majority by either party in Salem anymore, which is
hmm,
good news. So maybe we've got a fighting chance. I don't know. We'll see.
yeah,
No offense to anyone who takes that as a political statement, but 72 proposals that were passed, men, that landlords have had to deal with, housing providers have had to deal with in the last few years, and that's an extraordinary amount of change.
it's a lot of work. Yeah.
Yep.
Well, Dan, thank you again so much for jumping on,
Of course.
re-recording this with us. If you guys have any questions about property management, if you're tired of being a landlord, the first option I tell everybody is have you talk to a professional manager to take over. And then if that's not for you, then let's talk about selling your property or something like that. So Dan
Agreed.
Hayes is the guy I tell everyone to give a call to. I'll have all of his contact info in the email when this goes out. Dan, thanks again. Really appreciate it. And yeah, we'll chat soon. Thank you.
Thank you, guys. Bye.
Michael, thank you so much for agreeing to jump back on with us to re-record this. Really appreciate it. So let's talk about the commercial financing world. What's going on? Specifically, the questions that I get are like, what are rates looking like for experienced investors looking to buy in this complicated market?
Sure. Yeah. Thanks for having me. The rates in commercial, specifically in multifamily, they're hovering right in just under 6.
Okay.
It's going to vary a little bit if you're trying to really push high leverage, which when I say high leverage, I'm saying 70, 75%, anything over 65 really. You run the risk of it going closer to 6, maybe even a
Mm.
little bit above that, depending on the capital source. If you're lower leverage, purchase transaction, that sort of thing, you should be able to locate something in the 5.7, 5.8 range. If you have something that's really low leverage, there's some capital providers out there that are getting really aggressive on those.
Like sub 50%
Yeah,
leverage. Yeah, yeah.
yeah,
Gotcha.
yeah.
Okay. And what's the biggest hurdles buyers are facing? I mean, besides finding a deal that makes sense from an investment standpoint.
Yeah, so once you locate one that looks good, makes sense, the biggest hurdle I'm seeing is that there is still a pretty big spread between the going in cap rate and what we can get for a lending rate. So what this
Mm,
does is it creates something called negative leverage, and it's something that a lot of folks haven't heard about because rates have been so low for so long. We've been in this positive leverage, but negative leverage just means you're borrowing it under what your cap rate is. And so it
right. So
makes
you're
getting
you're
high
buying at a
leverage
five cap.
difficult.
Sorry, so
Yeah,
you're buying at a five cap, but your rate's at six. That's
correct. So that money is
okay.
costing you a
Yeah,
point, you
gotcha.
know. So it makes it difficult because our loans are based on cash flow, not on loan to value.
Hmm.
Makes it harder to get leverage. As an example, the other day I analyzed a loan that it was just basic multifamily, very struggled to get 65% loan to value. And so, just for fun, I thought I'd plug in some numbers from a year ago and see how it underwrote. And so I used, I think it was four and a quarter or four and a half, something like that.
Hmm.
And lo and behold, I got to 75% without any trouble whatsoever, even had room to spare. And I didn't change anything else. I didn't change my NOI. So my income and expenses were all the same, just the note rate. So it
Yeah.
makes a big difference. So if you're walking in thinking, "Oh, I'm going to get," you only have to put 25% down, it that may not be possible at until cap rates kind of edge up a little bit.
So when we, and obviously you know this, so when we are starting to look at a deal, whether it's from the buy side or the sell side, the first thing we want to do is we try to underwrite it to make sure it could get financed before we waste too much time on it. So we
Yeah.
we tend to use, I mean, we 2 years ago we were using 25%, but now I like to start with 35% down. I'm looking at right around a 6% rate, and we're trying to hit like a 1.3 DSCR. Is that still like an okay range to work with, or should that be tightened up a little bit?
Yeah, I think 1.3 is very conservative.
Okay.
So most lenders are at, well, there's two basic kind of lenders. There's the business bank lenders. They tend to be 1.25, so they're going to be a little bit more conservative in the way they
Hmm.
look at deals. Then you have other lenders and banks that actually have an apartment platform, right?
Okay.
So they're more property centric. They're going to tend to be a 1.2 debt cover,
Mm,
and they're going to be probably a little bit more favorable on aggressive underwriting than a business bank would be.
okay.
So I'm underwriting, again, depending on the deal. We look at each one individually, right? Location and what's the story on the property, that sort of thing. And so we're underwriting in between a 1.2 and a 1.25.
And how much on the expense ratio? How much are we looking at, like actual expenses versus like, well, stabilized, being though they should be around 35, but today, like explain how that is playing a role in today. I mean, because back then we used to just be able to say, all right, 30% expenses. I know they're at 45, but we'll get it down within 90 days, so not a big deal. How are we doing that today?
Yeah, so the way I look at when I first get a deal in and start analyzing it, I look at the current rent roll, right? If there's any vacants, I'll plug in highest achieved, or if the broker was nice enough to do rent comps, I'll use what the market rents would be. So that creates my gross income. Then I look at all the expenses and from the seller, and I'll plug in numbers that I know an appraiser will use. So regardless
Hmm.
of what their maintenance number might be, I'll go ahead and use what I think will show up on an appraisal. I'll use a market management number and all that. So I get to my gross expenses and I have my NOI. Then I'll go back and I'll look and I'll say, okay, what's my expense ratio? If I'm anywhere in the 30s, I'm not going to look at that number again.
Gotcha.
If it's coming in at 50, I'm going to go, okay, what's wrong? Did I miss something? Are the taxes high for some reason? Or,
Mm,
and sometimes the conclusion is, oh, these rents are way below market. So it is what it is. Other times I saw one come in the other day. It was at like 15%. And I'm
mm,
like, what's going on here? And it turned out, taxes were super low for whatever reason, but each unit was individually metered for utilities. So there
nice.
just wasn't a whole lot of expenses there. Like there was nothing I could do to bring it to
Yeah.
30%. So it just each property is individual, but I kind of go back into that number. If it looks
Yeah.
good, I just leave it.
Perfect. Perfect. Okay. So, one thing that I've been thinking about, we've had pretty incredible rates over the last few years, but commercial loan financing is 5, 7, 10 years, and then you got to pay it off, right? You got to refinance, you got to sell, whatever you got to do. So a lot of people who bought at 4, 3.5, 4, whatever it was. I mean, if that was 2 years ago, you know, 3 years is coming up pretty quick, right? That if they had a 5 year or a 5 year term, that's coming up quick. If they haven't been keeping their rents up, what do we do when the bank calls and says, "Hey, guess what? Your 5 years is up. You need to refinance or sell." I mean, what are their options? What do we got?
Yeah, so that's a good question. And it's something on a lot of the economists' minds, right? We don't know what's going to happen. We did encounter kind of a similar situation back in '07 when
Mm,
the financial markets collapsed. In that case, it wasn't, oh, well, what rate am I going to get and what that's going to do? It's, can I find any bank that's willing to extend credit, right?
mm,
So it was even,
yeah,
in my opinion, more drastic,
yeah,
and the market figured it out, right?
yeah,
They kind of went, okay, we'll just extend these guys for a couple years until we get through this because it's going to be short lived. So, short of that, I mean, I wouldn't bank on that happening necessarily because we
sure,
just don't know. It's too far down the road. So,
right,
what you can do as an owner is a couple things. One is push your rents.
mm,
We're in kind of a weird market where rents are starting to flatten a little bit. So you don't want to go too crazy with that. But if you're drastically under market, you got to do what you can to get those up to
yeah,
market because the loan amount you can get, regardless of the rate, the loan you can qualify for is going to be dependent on your NOI.
yeah,
So if you can raise that income, then that's going to help you. On the expense side, I would say, clean up your P&L as much as you can. It's fine for Uncle Sam to write off your car and your cell phone and meals and your capital expenses and those things, but when you're talking to a bank or a lender, you'll want to scrub those things out and make it
mm,
just property specific
yeah,
because they're going to use those expenses. And
yeah,
if you're consistently writing things off, they will count them as an expense. So that's going to
yeah,
hurt your NOI and then hurt your loan amount.
got it.
Um, Kind of a third thing, and this isn't for everybody, but I would say maybe think about bringing in some equity.
Mm,
Um, that could be from friends or family. Um, just in preparation for, hey, if my loan's going to be $100,000 or $200,000 lower than what my payoff is, I got to bridge that gap. If you can raise
right.
that from folks that need an investment, it might be a great solution.
Yeah. Yeah. That's a good idea. Okay, cool. So, I mean, really to wrap it up, what's your predictions on the coming year, rates, market wise? What do you think? What do you, with your perfectly clear crystal ball?
Yeah, it's about as foggy as everyone else right now. It's so hard to tell. Just even today, I feel like you can pull up any article to read whatever you want it to read.
Whatever you're
No
trying to
one,
justify, you'll
ex-
find the article to support it. Yeah.
exactly.
Yeah.
Powell's gonna, lighten up, and then others are saying no, he's gonna get, he's gonna keep rates going up. So
Right.
we don't really know. I think my personal opinion is that those pressures that we face here economically will start to subside by the end of the year.
Mm.
Whether that means we're in a recession or not, who knows? But some of that, we've already seen inflation come down, but what we're staring at that's causing the Fed to raise rates, I think that will subside. That the unknown for me is the international
Mm.
situations out there. You've got COVID still running through China and their policies. You've got war in Europe. You've got international supply chain issues. Those really could impact us. So it's hard to say how
Sure.
big of a part they'll play, but that would be what I would be looking at. I still think though that at least for our submarket, kind of the Portland metro Oregon area, look, our politicians are doing everything they can to try and control rent, but what it's doing is increasing values and
Yeah.
increasing rents. So I think it's a great place to invest if you can get in. Again, we talked about struggling to get proceeds, but if you can raise capital and find a good deal that's got some upside,
Yeah.
it's definitely a great place to invest. So I would just say be patient.
Yeah.
The
No
right
matter
deal for
what's
you will come along.
exactly, no matter what's going on nationally, Portland specifically is still really underbuilt for the demand, whether it's rentals
Yeah.
or occupied housing. Like it's just, you know, people need a place to live and they want to live in Portland and we don't have a lot of options.
And there's not a whole lot of starts out there. I mean, there's some
Yeah.
bigger projects that have been proposed and talked about, but they're not getting legs. So
Yeah.
that's going to help us in the long run.
Yeah. Cool. Awesome, Michael. Again, thank you so much for jumping back on with me. I'll get all your contact information in the email that we send out with this replay. And other than that, if you have any questions, reach out to Michael and he'll get you set up with that commercial financing. Thank you so much.
Great. Thanks, Ben.
Appreciate it. Bye. Michael, thank you so much for jumping back on with us. I know we had some technical difficulties last night, but today will be much smoother. No difficulties at all. So, actually, take a sec, introduce yourself, who you're with, and we've been doing business for 10 years, a decade,
I think so. Long time.
But people don't know you like I know you. So, besides dressing well and having a good, going to good cocktail bars, what else about you? What do people need to know?
Yeah, well, I've been doing residential mortgages for 18, 19 years, something like that. And as far as most of my clients go, when we're talking about investors in the residential space where it's my wheelhouse, where I can help people, we're looking at 1 to 4 units. So duplex, triplex, fourplex. And, like we had kind of chatted about before, there's challenges in this market, but there's also opportunities. There's flexibility in some programs that we haven't seen in a long time. And there's great strong indicators, I should say, that are showing us that rates are not only improving right now, but are likely to improve pretty substantially in the next 6 months or so.
Great. Cool. Well, on that note, go ahead and let's just jump into your slides and tell us what's happening in your world.
All right. Well, maybe I'll first start with just this idea of some of the flexibility in loan programs. So as many people are likely aware, rates are quite higher than they were a year ago. However, they've come down about a full percent from their peak in November, December of 2022. And we're seeing, as I mentioned, a good trend develop here, and we'll touch on that in a moment. But from a loan perspective, when you're looking at buying, especially a 2 to 4 unit residential property, 30-year fixed terms, which are still pretty common in our industry. Again, I'll tell you more about that with the inverted yield curve and how longer term loans are actually priced a little better than shorter term loans. But you're going to pay anywhere from 2 discount points, which means 2% of your loan amount, or even a hair more, to land a rate that's in the low sevens, mid sevens.
Wow.
So, not beautiful, but we are seeing those come down. We are seeing a lot more opportunity with concessions from the seller that we did not see in the 3% interest rate range, where tons of buyers are competing for the same property. But we're also seeing good flexibility for investor loans. One of the most common ones we've used a lot this last year is the debt service coverage ratio loan, or DSCR for short. And I know you're familiar with these, but many people don't know how simple these loans are. Typically when you're getting a residential mortgage, you are basically guilty until proven innocent. You're giving every financial document you've ever had. It's pretty strenuous. With these programs, other than your credit score and a general application, we're not looking at your income. We're looking at your credit history, but we're really looking at the property. How's it going to perform?
So
And
this is really common. This is 5+ units. I mean, that's how we underwrite properties when we're looking for clients. I love that it's a thing for and under unit owners now. It's huge.
Yeah. So you know how it works, and it makes it a lot simpler. There's also bank statement cash flow financing we can look at as well. So again, that's one of the things we're seeing becoming more popular. There's more competitors in that lending space, and that's helping the pricing. And as we see rates improve, that's a good trend that I think we'll see develop in 2023. And speaking of trends and what we're expecting to see, let's get this up here. And just to talk a little bit about what's going on out there, the 3 most popular Google searches in the last few months have been recession, it has been housing crash, and it has been inflation. So these are the big things that are on the majority of people's minds right now. And in part, it's due to real estate experts like Diana Olick here from CNBC that is putting out a lot of information that scares people. And like you see a headline like this, it's no wonder that we had people just sitting and pausing for the Q3 and Q4 of last year. And the reason why this is pretty scary is because people are making or not making massive decisions for their financial future, honestly based on a lack of good information. And we keep hearing the term, and people are searching the term for housing crash or housing crisis, but in reality, what we really have is an information crisis. So not to spend too much time on this, but this particular expert alone that we just looked at has been making claims of real estate bubbles about to burst and home ownership not leading to true wealth since 2015. And if you've been following the real estate market from 2015 through 2021, you would know with certainty that those claims were not only false, but completely the opposite and really unfounded. So the point of that is when we look at true economic indicators, we're getting a much different message. So I'm just going to flip to a couple things right here. And charts aren't the most exciting thing to look at, so I'll try to be brief here. The point is people wonder what mortgage rates are doing. When they hear the federal funds rate is going up, they assume, oh, my first mortgage rates, those are going up. They are not tied together. Now, the federal funds rate drives the borrowing rate overnight from banks, and it drives a lot of consumer finance. It drives a lot of loan decisions. And as we saw, it definitely affected real estate in many, many ways, but it's not tied directly to how first mortgage rates work. Mortgage rates follow inflation. And this chart, and since this stuff has been tracked for decades back, this relationship has tied together. The bottom line we see here is the CPI, and this is what the Fed watches more closely than anything to determine inflationary pressure or deflationary pressure. As we see inflation move up, we see mortgage rates, the 30-year fixed mortgage rate, follow along. when it comes down, rates come down. When it moves up, rates will start moving up. And the only time that that doesn't happen is when the government steps in and changes the game. So QE, quantitative easing, this is the government buying mortgage bonds, issuing debts, and being the main buyer of those debts and controlling interest rates. They're the reason rates went from getting into the high fours before 2020 and drove them down to record lows that we likely will never see again. But as soon as they eased off of that plan and stopped buying and basically controlling the mortgage-backed security market, when inflation starts its move up, mortgage rates followed quickly. And that's why we saw that big turn. The reason I bring it up is right here in what we're seeing right now. As inflation comes down, mortgage rates follow. And one last thing, just to show you why we're confident that we're going to see this trend continue, is how that consumer price index is calculated. Currently right around 6% year over year. Well, it's tabulated going back 12 months, and each month's rating of where that CPI was. So as we move forward, we drop off 12 months ago. That's why in December we saw inflation numbers come down. And as we move into January and that data gets reported, it's going to be down in this range and we drop up another high mark. And that will continue to show the government that inflation is curbing and it's coming down, and mortgage rates will continue to follow that pattern.
Great. Okay. So, hold on, I gotta add myself. There we go. So, if you're, I mean, a common phrase is in real estate, which I'm not necessarily a fan of the phrase, but I get what they're saying is, marry the house, date the rate.
Right.
In a market like ours, here in Portland, we still, and I'll jump into the availability numbers of what we've got for sale now. But if you're out there looking for an investment property, would you be saying, hey, if you find that right property, buy it now? Or are you saying, hey, you know what, in the next 6 months, I'll bet you're going to get a much better rate. Maybe you should wait. What are your thoughts around what the market's going to do?
Well, I think this fits with everybody's decision, and whether it's an investment property or a primary home, although that's got some other things added to it. Typically, you can't time the market. You certainly can't time rates. But when you find a great investment, which I think, and you know this stuff, it's going to be the long-term impact of what this can do for your wealth.
Yeah.
I don't think people should make decisions speculating on what's going to happen. You make the decision based on the known factors right now. And if you're looking at investment property and the rate's 7%, but you also know that you're able to perhaps increase the rents of that particular property with different investments, with different things that you could do to it. And also keeping in mind that restructuring debt is common. When rates were 4 to 5% and people are buying real estate like crazy, they probably didn't speculate that the rates would drop to 2.5%.
Right.
But then they got this great opportunity. And I think that finding the right location and the right investment for somebody, it is tied to the borrowing and the leverage, but I would say that I would move forward on a smart investment. I've done that myself. And if there's opportunities down the road to enhance that investment, one of those opportunities may be tied to restructuring the financing, but there could be other ways of doing it. So, I mean, I think there's always opportunities, and especially when there is far less competition, when someone's looking to sell, they're probably motivated to sell. And you know this better than anybody. And so structuring the terms of that transaction, you may have way more flexibility. You may be saving $10, $15, $20,000 in typical costs the buyer would take on, because you're not competing with everybody and there's not as many people looking to buy right now. So I think you get different advantages in a market like this. But as I said, the indicators are going to show rates improving pretty substantially, and there'll be an opportunity then to restructure that debt and amplify the return on that investment.
Yeah, and the things that I hear from people are, well, I need to wait till prices come down. And then they also say, I need to wait till rates come down. But those don't happen at the same time, right? So rates go up, that pushes competition out, gives you better opportunity to buy, less competition. But if now you're saying you're going to wait till the rates drop, well, so is everybody else. If those rates drop down into the low fives, then guess what? Everybody's back in the market driving that price back up. So I'm not a fan of just pushing people and just buying properties to buy properties. Find the right deal. If you find a deal that works at a 7% interest rate or even an 8% interest rate, well, that's going to look really good when you refinance it 3 to 4 years at a 4% rate. Like you're going to be doing really well with those new rates. So just make sure that the investment you're making, that the numbers that don't buy it if you're negative cash flow, but if it's a good investment at these interest rates, pick it up. That rate, you have an opportunity to get out of that rate down the road where you might not have the ability to buy the investment down the road. But
Right. I agree with
any
that.
any other final thoughts on the market or anything else you'd like to throw in?
I mean, I think we touched on it pretty good. I think that there's opportunity there. People are making um, great investments right now. We're working with people like that right now, and I think that to your point, you can't time a market perfectly, but you can make sound financial decisions based on known factors now.
Mm-hmm.
And to your point, if those numbers work and it makes sense, then don't wait for rates to drop. Don't wait for prices to drop. Make the move. And again, there will likely be opportunities to restructure financing and just improve that already good investment that you made.
Awesome. Thank you so much, Mike. I really appreciate it. Mike's contact info is going to be in the email that we send out with this replay. So if you have any residential lending needs, primary residence, second homes, investment non-owner occupied investments up to 4 units, reach out to Mike. He's the guy who does my own personal loan. So can't shout how great he is more than that. So anyway, thanks again, Mike. Really appreciate it, and we'll talk to you soon.
Thanks.
Thanks. Martine, thank you so much for joining us again today. Obviously, we had some technical difficulties. This time we'll go off without a hitch, I promise. So, Martine, why don't you tell us a little bit about yourself and then jump into what's going on in the residential real estate world?
Well, sounds great, Ben. Thank you for having me, and thank you for all attending or re-attending, watching later. My name's Martine Tamick. I'm a residential real estate agent. I've been licensed and working in Portland since 2013. I've spent my whole adult life within real estate. I was a property manager. I've worked in commercial and have found my love in residential real estate. So here to give you a market update on where we've been and what we're going to potentially see this year.
Perfect. All right. So let's jump into it. Give me the details. What's going on in your world?
Sounds good. I'm going to start driving this presentation. All right. So I'm here to talk about the residential market update. And what we're looking at is just a quick market overview, 2022 in review, and then I really want to focus on the present, and then our outlook for 2023, and maybe some considerations of how that applies to you regarding buying and selling. So I love this quote: "In like a lion, out like a lamb," and I really feel like that applies to 2022. Why? What we saw was one of the strongest markets on record. And that was because of low inventory, interest rates that were still low, but rising. And those fears really drove consumers and buyers to the market, which created competitive situations. And then we also continuously have a strong investor impact. So mom and pop and institutional money that has flooded the markets and usually accounts for about 25% of that demand. So if you were a spring buyer, you really felt this. If you were a seller, congratulations, you made a lot of money. And this little chart that I have here just kind of shows you month over month for the last 3 years, what inventory has looked like. And if you look at that January, February, March, April, I mean, we were sub 1 month of inventory. So that just tells us that the competition and the absorption of the available inventory was just flying off the shelves. Then the lamb part, right? We hit kind of mid-May, June, interest rates had popped up to 5%. That's a 2% increase from the beginning of the year. Seasonality always is something that we have to consider and take into consideration, because that really is an overall affects the total market. We continue to see high prices even though interest rates had risen. So the correlation between interest rates and prices were still affordable. So we're getting out of affordability. So it really slowed down that demand. And then I think that we have to acknowledge where we've been since 2020, right? So if you or anybody you knew moved within the last 2 years, but maybe weren't planning on moving for the next 5, all of those moves happened. So we had 2 years of 6 million plus sales in the US. And so if you were thinking, anybody who could move moved, and we maybe front loaded some of the sales or transactions that we would have seen the rest of the year or even into 2023 in the last 2 years. So I just want to kind of hang that up. Like, that's just where we were. We can't do anything about it. And now we're going to kind of come into what the present moment looks like. So some things to just consider. Prices are still high. We saw a 6% growth here in the Portland metro area year over year. 6.8, so almost 7% on the average sales price. Now, some areas of Portland saw probably more than that, and some areas a little less than that. I think that we also have to consider, yes, we're up year over year, but we're definitely down month over month and have had consecutive 3 months of price decreases, right? I think something also to really think about and consider is that the human spirit is so good about adapting that as we've moved into 2023, the consumer and say buyers are already getting accustomed to dealing, with higher mortgage rates. And the way that I measure that is like the words buy down, adjustable rate mortgages or ARMs, seller financing are these household words that we really haven't heard since the downturn and the Great Recession, and really buy downs were a big thing done. 2-1 buy downs were really done in the 80s. So we're seeing that high interest rate environment bring back these household or these terms. So yeah, we're already accustomed to those higher interest rates, and we're working through them, right? And homes are still selling. Again, seasonality just is a factor. I think a great just I don't know quote or I don't have the word for it, but something to keep in mind is that in the United States, we see about 40% of all residential real estate sold between March, April, and May. So that's close to 50%, right? So that tells us that seasonality really plays a key factor to how much homes are being sold in what period of time. So my expectation with seasonality and what we're already seeing come the middle of January is that demand is picking up. I think that we're on the other side. We're getting days that are longer, right? And we're on the other side of a really busy holiday season. People are getting their tax returns, and they're accustomed to the high interest rates, and there are people that still want to buy homes. Lastly, something that I think that is going to continue to be a trend that we're talking about and we're hearing about is that inventory is still very, very low. And there's a few things that have affected that inventory. One, I mean, we have had a decade of underbuilding. We do not have enough homes for the amount of household formations that have happened in the last 10 years. I know Dan Hayes touched on that within the rental market and availability, and but we're still seeing that in residential real estate too, along with what we call is lock-in effects. from years and years of low rates and high prices. So if you're out there trying to buy, if you want to sell your home and maybe get into a bigger home, you almost can't afford that bigger home with the higher interest rate because you have a 2.5% interest rate on your current mortgage. So
Mm-hmm.
that really has made it that people aren't putting their homes on the market because they have this kind of golden shackles to the rates. So that is continuing to keep our inventory locally super, super low, but there's demand. So that's keeping the prices high.
So real quick, let me jump in real quick. It sounds to me like there's a real opportunity if you've got some single family rentals that are tenant occupied or sitting vacant or whatever. Um, Now is the time to do that, right? Now would be the time. Like if you've got your primary with a 2.5% rate, don't get rid of that one. But your rental, now is the time with the demand out there to get that on the market and get that sold because the demand's through the roof.
Yeah, I think that if you're thinking about selling in 2023 or 2024, that there's no good time like the present. We have a lack of inventory, and we do have people out there looking to get into homes. The last two offers that I wrote just this last week had multiple offers. We still got some pretty favorable terms on the buy down side, which is great, right? Because both sellers and buyers are coming to like a meeting of the minds of understanding how do we make this affordable but not erode value for the seller. So I think that we want to start having those conversations, and there is a small window of opportunity to kind of get ready and get on the market before the end of May. I think by the end of May, as we transition into June, when everybody's graduating, having weddings, going on vacations, and dealing with their kids, like that drop off, you will feel it. And we've felt it since we've been recording, since we've been keeping track, really.
Mm-hmm.
We want to make sure that if you're going to, take advantage of the market today and the seasonality, then you want to get in front of those buyers when there's the most demand. And what
Yep.
did we just say? 40% of all real estate will sell in those 3 months. You want to be that seller and not the seller that sells in August, September, October, and have that decrease. And when you're looking at like Joe got 20% in spring last year and May got 6% year over year, right? Because of timing, really. So
Yeah.
we want
And
to.
one quick note about that seasonality. It is a little different on the multifamily side than single family. We don't see there is seasonality, just not nearly as wide of swings, but the point remains. So
Right. Great. Thank you for adding that in. So just kind of wanted to throw in a couple of charts and kind of show you that seasonality. So if you're looking at, do you see that? Is that
I do see that. I don't know why it's there.
on there?
We'll pretend it's not.
We'll pretend it's not. We're not going to get away from those technical difficulties. Anyway, so what you're seeing here is this kind of rise and drop, and rise and drop, and rise and drop, right? So this is, year over year trend, but you're also seeing the seasonality here. And I kind of just wanted to illustrate that for you. And then kind of a big drop here, right? This really steep incline in March of 2022, and as we ended that year, kind of that lamb came in, right? All right, and here we just again kind of wanted to speak to, yes, we're up 7% in the Portland metro area, about 7% in the Portland metro area, but the reality is month over month we are seeing big decline, a decent decline, and in price, from where we were. And I think that's just important to note, because people felt that.
Yeah.
All right, so some things to consider if you're on the uh, things to consider. Bottom line, I think with the softening mortgage rates and strong jobs reports that we've created, there's a creation of a tailwind into the year, right? So we've seen rates probably peak in about November, like Mike Popno had mentioned. And now we're seeing strong jobs reports into this spring, and we're feeling people get out there. So just a data point to consider. We saw showings drop in December to about 6,000 a week, which is very, very low. During the spring of 2022, we saw them as high as 23,000 showings. I know, right? 23,000 showings. But we're already up about 50%. So we're seeing about 13,000 showings this second week of 2023. So we're already, spring has sprung, and selling season has begun. So if you're thinking about, selling, I think that this is the time to really start having those conversations and planning. The other thing to just understand is that there are there are recession concerns. And I think that going into the second half of 2023, it'll be interesting to see what happens. I know some of the guys here have some predictions. I'm going to say seasonality is going to play out like it typically does. And hopefully the Fed can deliver its soft landing, and we don't see, huge layoffs or really big or a deep recession. But I don't think so. I think we're kind of coming out of that, but who knows? I wish I had a crystal ball. And then, so some things if you want to buy it. I think that right now, today, we are getting favorable terms, and that means maybe a little under asking. We're definitely getting seller paid closing costs, some buy downs from the sellers, and definitely some repairs. You're not giving away your first child come January of 2023, but you might be signing over some rights come March and April, but that might be the hope. I think you might find discounts later in the year, depending on what the rates do. But if rates drop more, know that you will be competing with more people. So I think that one of two things that as a buyer, if you're thinking about buying, don't hold out for rates to drop. You can always refinance. And if you think rates are going up, you should be getting in the market now so that you can take advantage of 6% interest rates. I mean, that's still a great interest rate.
Yeah.
And on the sell side, seasonality, I mean, can't stress enough that in Portland for the single family homes, that's going to play a huge part in your proceeds. So I would say, we want to get your home on the market between February and April, because we see a slowdown usually starting right around May. Please consider the time that it takes to get your house on the market or your property on the market, whether it's tenant occupied, not tenant occupied, if it's a duplex. All of this stuff does take time. And we want to make sure, and it's already January, so we really want to make sure that we're having those conversations, we're running those numbers, and really setting you up to maximize what you get for your home. I really think with low inventory for sellers, it's always going to show up in your net proceeds as a positive, because there's just not a lot of competition. So you're getting those buyers.
Great.
That's kind of all I had. Ben, do you have any
Perfect.
questions? Anything you want to highlight with me?
No, I think we touched on it quite a bit about the opportunity that owner or tenant occupied single families have at the moment. There's a huge demand for that. It has affected the small plexes a little bit. As there's a little more inventory in single families, they're moving away from owner occupied duplexes, but that's still a great target as well. So if you have a vacant unit in a duplex, having that open to owner occupants is huge right now.
I think
Yeah,
too,
and
to
yeah,
touch
go
on
ahead.
that piece, Ben, is that I do feel this tailwind of millennials really looking at different investment opportunities to grow their net wealth. So I think, like you said, that owner occupied, I even though we have a little bit more for sale or single family, the mindset of the millennial and what I hear people talking about and just the trends that I'm seeing is that we don't have the pensions that we used to. We don't have that fallback. So people are really looking for those other ways to set their lives up. And I think we're really seeing a shift in the way that people are thinking. So I think as we go into, the year, we will see more and more people want to be an owner occupy and kind of start their own wealth there.
That's awesome. Awesome, Martine. Thank you so much again for jumping on to re-record. I really appreciate it. And yeah, I appreciate you guys will be hearing a lot more from Martine. She's going to be joining me at a lot of these webinars and handling the single family referrals that come my way. So we'll get going from there. Thanks, Martine.
Have a great day. Bye.
Bye. So we've got a lot of great information from all of our guests today, and I want to run over some final thoughts and kind of action items that I think I would tell everybody to be taking, whether you're looking to buy or sell or whatever. Well, actually, before I jump into this, I want to touch on something. When you work with any of these guys, whether it's Mike or Dan or the other Mike or Martine, our goal, obviously we all get paid when deals happen. So it would be easy to assume that when we have a conversation, I'm always going to tell you to sell. I'm always going to tell you to buy, whatever. That's not actually the case. Most of my conversations today are you and I should work together in 3 years when you get your rents up. When you execute this plan to maximize the value of your property, then let's talk, right? For some people, it makes sense to do a deal now, for sure. For others, it does not. And all of us on this webinar are very cognizant of the fact that our responsibility, our duty is to look out for you and your investments and make sure that you guys are making the most intelligent choices you possibly can. So we're going to try to give you all the info. And I've said this many times on my other webinars, but the goal of these webinars is not to say you owe us a deal, you owe us the listing, or you owe us the purchase. That's not it at all. What we want to do is provide so much value that when the time comes for you to have a conversation about your real estate plans, you at least give us the opportunity to have a seat at the table for that discussion. Now, we are not entitled to that deal. We don't expect that deal, but we would love to have that conversation. And our goal is to earn the right to have that conversation with you when the time is right. So let's jump into some final thoughts and actions here. Everybody here needs to develop a plan to execute in 2023, not just a plan to talk about and not do anything with. I've got friends of mine that I helped buy properties 5 years ago, still haven't raised rents, right? That's not what we're here for. We are here to help you execute your plans to make sure that you are protecting your asset and maximizing the return on your investment. So to do that, we need to analyze your portfolio, get a rent analysis, get a valuation on your properties, really dig in and see where you have opportunities, whether it's in upgrades in your properties or better leverage with a refinance, or maybe you've got way too much equity and your return on equity isn't right, which would mean it's time to redeploy some of that equity into another purchase. Or maybe it could be, I don't have the capacity to keep up with the city of Portland's changes, so let's do a 1031 exchange and go buy in a cash flowing market somewhere else. That's one of the opportunities that we can help you discover. And then we got to execute on that plan, right? We've got to help you get your rents up. We got to help you get your expenses down. Multifamily investment real estate is valued based on the income streams it brings in minus the expenses, right? That's your NOI, your net operating income. From there, that's what people are buying, is those streams of income. So from there, we can back into valuations and we can back into values. But really, if those rents are too low because you love your tenants, those expenses are too high because you love your garbage service and you don't want to call to have that conversation, well then you're going to be losing out on not just that extra couple $100 a month, but what that translates into overall value when it's time for you to sell. So if you're thinking of doing something in the next 3 to 5 years, you've got a lot of runway to do the work to make sure you maximize that value. And once you've executed on that plan, things to consider. Is it going to be easier or harder to be a landlord in the next 3 to 5 years in the Portland metro area? Does that mean moving to another market? Or does it mean picking up opportunities when they present themselves here locally? But either way, are you prepared? Is your portfolio ready to take advantage of a market that presents itself? Or are you tired of being a landlord here locally and you're looking for more landlord friendly places like Florida or Texas or Oklahoma, right? Or more cash flow friendly places, right? Portland's great for equity growth, but the cash flow is tough coming in to buy when you buy opportunities, but that equity growth is really the opportunity here. So either way, we want to help you execute your real estate plans in 2023. So if you have any questions about financing or property management or valuations or whatever it might be, do not hesitate to reach out to any one of us. The email replay that we're sending out is going to have all of our contact info. Reach out and have a conversation, and let's make sure that at the end of 2023, you've looked back and said, I've added 6 figures to the value of my portfolio. So give me a call. You'll definitely be getting an email for the next one that's coming up end of February. But don't hesitate to reach out with questions. I can't wait to work with you guys. I look forward to hearing from you all. And thank you so much. Oh, I didn't mean to do that. Thank you so much for joining us today. And I look forward to talking to you all soon. Thank you so much.